Only 142,000 jobs were created in September, well below the 200,000 economists were looking for. The numbers were also revised lower for the months of August and July. So what does this mean for the Federal Reserve and its looming rate hike? I'm joined now by Lindsey Piegza, the chief economist at Stifel Fixed Income. And Lindsey, welcome. It's great to see you here.
Thanks for having me.
So what an incredible report. Only 142,000 jobs were created, and the numbers were revised downward for the past 2 months.
Very disappointing any way you cut this, from the headline number to the previous month's downward revisions, to flat average hourly earnings, to a stagnant work week, to decline in the participation rate. Where do we stop? It was a very disappointing report, really reinforcing the idea that the second half of the year in the U.S. economy is going to be very lackluster at best. As you know, a decline in headline job creation generally translates into a decline in overall activity for the economy.
And what a mess for the Federal Reserve.
Exactly. I think if we can put it in one word, it was thank goodness. Thank goodness we didn't raise rates in September. Certainly this back-to-back decline, I shouldn't say decline, but weakness in headline job creation reinforces the need for the Fed to remain patient on the sideline, certainly through that October meeting, but definitely through the end of the year as well, into 2016.
Well, many economists are now looking at a December rate hike, but you've been saying that the Fed will raise rates in 2016. You've been saying that for some 2 years now. So where are you on your rate hike expectations right now?
That's right. We certainly maintain our 2016 forecast. As I mentioned, I do anticipate a continued slowdown in the economy for the second half of the year, keeping the Fed sidelined. But now the question is, will the economy actually be able to gain enough momentum in 2016, so meaning next year, in order to allow the Fed to raise rates? Perhaps we need to start talking about 2017 as a potential liftoff date. If the economy doesn't recover enough and we continue to see weakness, the Fed has nothing to do. Their hands are tied. They'll remain on the sideline.
But would a 2017 rate hike put the Fed in an even tougher situation, because now you'd have rates at record low levels for, what, 8-9 years?
Well, essentially, they're just extending their position. We've been waiting for this first rate increase since 2006, but the Fed has been very clear that it's not about the calendar. It's not about the number of years that we're sitting at zero interest rate policy. It's about the underlying fundamentals. We thought the labor market was moderately stable. We've now lost momentum there. You add in non-existent inflation, and it's the perfect storm to keep the Fed at this very accommodative level of policy for quite some time.
All right, now the markets are pricing in a 30% chance of a December rate hike after this jobs report, compared to 44% before the jobs report.
Right.
We also saw the 10-year Treasury yield fall below 2% for the first time in August. What do you make of all that?
It certainly is adding to the volatility for the markets. This was not a good report for anyone. The equity markets see this as declining fundamentals against the backdrop of a Fed that continues to posture a rate increase by the end of the year. So certainly not creating favorable conditions for equities. On the flip side, this may suggest that the Fed has to wait until, as I mentioned, 2016 or beyond, and this will continue to put downward pressure on Treasury rates.
All right, just real quick, let's talk about wages. Average hourly earnings up 2.2% over the past year. They actually dipped somewhat negative for the month of September.
Certainly.
Economists were expecting a 2.4% increase. Again, another example of the Fed being pushed into a corner.
This was going to be the saving grace of the headline increase. As you know, the median consensus was looking for a disappointing rise around 190, 200,000. But most economists were saying really the main component that we have to watch is average hourly earnings. And if we do see that 0.3, 0.4% increase, this would be enough to save that report as favorable. But as you mentioned, that too fell short of expectations. No change in wages, keeping us stagnant at that 2% rate that we've seen since the end of the recession. And this really has been a sticking point for the Fed, that independent of near 60 consecutive months of positive payroll growth, we have not seen that wage pressure. And that's what the Fed is waiting for.
That's what the Fed is waiting for. And of course, they meet at the end of this month. We'll be watching that. Lindsey Piegza, the chief economist at Stifel Fixed Income. Thanks very much for coming in. I'm Scott Gamm, and you're watching The Street.